Hey everyone, and welcome back to The Explainer. I am absolutely pumped to take you through today's deep dive because we're throwing a truly fascinating company right into what I like to call the gauntlet. We are going to put the highly volatile diagnostic giant QDEL Ortho, trading under the ticker QDEL, to the ultimate test. You know, as an investment analyst, I absolutely love looking at polarizing stocks, and this one, well, it's pretty much the definition of a battleground. We're going to pass its financials through the legendary value investing frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, and then we're going to run the hard math with our own discounted cash flow models. So strap in, because this stress test is going to be incredibly revealing.
Here's our roadmap for today. 1. The QDEL Ortho Snapshot and Crisis. 2. The Warren Buffett Lens. 3. The Peter Lynch Lens. 4. The Ben Graham Lens. 5. Our DCF valuation. And 6. The synthesis and final verdict.
Okay, Part 1. QDEL Ortho Snapshot and Crisis. It really is a paradoxical position.
Now, just look at this massive 35% stock rally. I mean, it happened essentially overnight. QDEL Ortho recently saw its shares just absolutely rocket up after reports started surfacing that they're in talks to sell their point-of-care testing unit. And we're talking about the unit behind the very first FDA-approved rapid COVID influ antigen tests. Heavy-hitter private equity firms like Advent International, SK Capital Partners, and Archimed are reportedly circling with a valuation of roughly $1.5 billion for this asset. Retail sentiment jumped straight to extremely bullish, with investors basically praying this cash injection could save the day.
But, we really have to look at the brutal reality behind all that hype. The business's current health profile brilliantly illustrates why QDEL Ortho is so desperate for that $1.5 billion lifeline. The company is facing a downright existential profitability crisis. I mean, we're looking at a devastating negative 76.6% net margin. Their total free cash flow sits at negative $112.1 million, and get this, they're burning an estimated $2.1 billion annually. They are completely suffocating under the weight of a massive $2.6 billion net debt load, which mostly stems from their 2022 combination with Ortho Clinical Diagnostics. So yeah, they have incredible top-line scale, but their profitability profile right now is just bleeding red.
So, the crucial takeaway here is that we've got a company with two completely opposing narratives fighting each other. On one hand, they possess this staggering 99.84% market share in their specialized in vitro diagnostics niche. That's basically a monopoly. But to survive the post-COVID market normalization and that crippling debt, they've had to initiate some truly desperate emergency restructuring. They are targeting $25 million in Q1 cost reductions. They're slashing executive compensation by 25%, establishing daily cash flow monitoring, and frantically hunting down over $500 million in underperforming assets. It's literally a race against time.
Moving on to Part 2, the Warren Buffett Lens. We are searching for moats here. As we all know, Buffett absolutely loves an economic moat. And surprisingly, QDEL Ortho actually has one. They have that incredible 99.84% market share in their niche, 96% recurring revenue creating super high customer switching costs, and $2.8 billion in massive revenue scale. Buffett would normally drool over the predictability of that recurring revenue and market dominance, but then he'd look at the debt and profitability. A hallmark of the Buffett framework is manageable debt, honest management, and a high return on equity. Well, QDEL's $2.6 billion net debt pushes their leverage to a scary 4.1 times adjusted EBITDA, and their return on equity, a dismal negative 49.95%.
For Buffett, intrinsic value and that all-important required margin of safety are derived from consistent owner earnings, which is essentially free cash flow. With operating cash flow at negative $33 million and free cash flow at negative $112.1 million in their most recent quarter, owner earnings are just completely non-existent. Because of this, Buffett wouldn't even attempt to calculate an intrinsic value or gauge the upside. The required margin of safety simply cannot be established here. So, for Warren Buffett, the verdict at the current price is a hard pass. He'd wait for positive owner earnings before he ever even thought about touching this.
Section 3. The Peter Lynch Lens. Is this a turnaround or a value trap?
Lynch categorized stocks into distinct stories. Slow growers, stalwarts, fast growers, cyclicals, asset plays, and turnarounds. So I have to ask you, is QDEL a classic Lynch turnaround combined with an asset play, or is it just a sinking ship? I mean, they're actively negotiating the sale of an asset worth roughly $1.5 billion, which is just massive compared to their depressed market cap. It makes this a truly fascinating categorization puzzle.
Looking closely at the Lynch metrics, we know Lynch loved the PEG ratio, price to earnings over growth. But QDEL has negative historical earnings, making a standard PEG calculation mathematically impossible. Actually, scratch that. If we look at their forward PE based on projections instead, it sits at a very low 8.97, which definitely hints at some cheapness. However, Lynch always demanded a strong balance sheet. With a debt-to-equity ratio of 1.55 and an interest coverage of -5.08, QDEL fails the balance sheet test miserably. On the flip side, though, Lynch liked seeing smart money moving in quietly. The heavy interest from institutional private equity firms looking to carve out that point-of-care business gives this an intriguing pass on institutional interest. So for Lynch, we're probably looking at a highly speculative hold.
Okay, part 4. The Benjamin Graham lens. Pure, strict, quantitative value. Graham was absolutely ruthless with his defensive investor checklist. Let's run QDEL Ortho through it, point by point. Adequate size? Pass. At $2.8 billion in revenue, they're definitely a major enterprise. Strong financial condition? Fail. Graham wanted a current ratio of at least 2.0, and QDEL is sitting at 1.43. Earnings stability? Immediate fail due to those deep negative net margins and a recent EPS loss of 40 cents a share. Dividend record? Fail. Moderate PE and price to book? Well, this one's mixed. Graham loved a low price to book, and QDEL's is an incredibly cheap 0.62. That means it's trading well below its theoretical liquidation value, which is interesting.
But all of this brilliantly illustrates the harsh reality of Graham's intrinsic value formula, which multiplies the square root of 22.5 by earnings per share and book value per share. Because QDEL's current trailing earnings per share is heavily negative, the mathematical output of Graham's formula literally collapses to zero. A strict Benjamin Graham investor wouldn't touch this stock today, viewing that lack of earning stability as a total violation of his primary rule. Always protect your downside margin of safety.
Moving on to part 5, let's get into the DCF valuation, the raw math, and our assumptions. So, all 3 of our qualitative gurus are out based on the trailing metrics. But if management actually executes their turnaround, future cash flows are going to look drastically different. To build our base case DCF, we have to make some informed assumptions to bridge the massive gap between their current negative $112.1 million free cash flow and their future potential. Assumption 1, the restructuring works, stabilizing their $2.8 billion revenue base and returning them to the industry standard 8% free cash flow yield over a 5-year forecast period. Assumption 2, we apply a 10% weighted average cost of capital to discount those cash flows, reflecting their high debt risk. And assumption 3, a modest 2% perpetual terminal growth rate.
Notice how incredibly sensitive the valuation is to our recovery assumptions. If the turnaround succeeds, look right in the middle of the data. At our 10% discount rate and a 2% terminal growth rate, the math outputs a very specific fair value. But notice how quickly that value just drops off a cliff if the risk, represented by a higher 11% WACC, increases. It drops the value all the way down to $15.50.
At our base case, the DCF spits out a fair value per share of exactly $18.63. Now, this is fascinating because it aligns perfectly with the 12-month average Wall Street analyst price target from our source data. If they can just survive the debt crisis and normalize their margins, the math suggests some pretty significant upside from these distressed trading levels, assuming, of course, you actually believe in the turnaround story.
Finally, part 6, the synthesis and our final verdict.
Before we give the final verdict, let's pull in a few other models just to round out the quantitative picture. Check out these comparable multiples. A forward PE of 897 indicates it's heavily undervalued relative to the broader market, again, if those future earnings materialize. An enterprise value-to-sales ratio of just 1.46 shows the market is pricing their massive $2.8 billion revenue stream at a severe discount. And that price-to-book ratio of 0.62 means the stock is trading below its accounting liquidation value. By pure multiples alone, QDEL looks incredibly cheap.
This master summary really illustrates the deep divide we've uncovered today. The strict value gurus, Buffett and Graham, they reject the stock completely due to the negative cash flow, lack of earning stability, and that crushing debt. Their trigger to buy literally doesn't even exist right now. Intrinsic value's effectively zero. But Peter Lynch would likely label this as a speculative hold, waiting to see if that 1.5 billion point-of-care unit sale actually executes to fix the balance sheet. Meanwhile, our forward-looking DCF and the analyst targets point to a fair value of $18.63. If you're conservative and demand a 30% margin of safety on that DCF, your trigger price to buy would be sitting right around $12.50.
So, here is our definitive, data-driven, final verdict. If you are a strict value investor focused on trailing metrics, stable margins, and clean balance sheets, QuideL Ortho is a resounding sell or avoid. That $2.1 billion annual cash burn rate and the negative margins are just way too toxic. However, if you're an investor looking for a high-risk, high-reward turnaround or asset play, this is definitely a highly speculative hold. That 99.84% niche market share is real, the recurring revenue is real, and if they successfully carve out their point-of-care business to private equity, it could instantly deleverage their balance sheet and unlock some massive value.
I want to leave you with this final, provocative thought to take away from our explainer today. QuideL Ortho isn't alone in this struggle. Across the entire medical technology landscape, companies gorged on debt to consolidate during the pandemic boom. And now that testing is normalized, they are facing a severe hangover. Can these post-COVID diagnostic giants innovate fast enough and slash costs deep enough to survive their own debt? Or is private equity just going to swoop in and carve them all up for parts? It's a high-stakes race, and the clock is definitely ticking. Thank you so much for exploring this data with me, and as always, keep your eyes on the numbers.